because we have some folks in the audience, but I will talk as loud as I can so the folks that are tuning in from the Zoom can hear us, and I'll try to stay in this general area. Okay, so my name is Eugene Marshell, and I'm the founder and CEO of Magnolia Tax Services. Magnolia Tax Services is a tax advisory practice that specializes in tax planning, tax preparation. We also do tax representation and accounting for businesses and individuals. We have over 600 agents in our practice, and we have 2 offices, one in Chicago in the West Loop and another office in Milwaukee, downtown Milwaukee. We're 100% remote. We have 9 team members in our practice based out of various states. That's Wisconsin, Illinois, Florida, California, and Nevada. So we just got to the juicy part of the presentation where we started talking about what you can claim on your taxes, how to be proactive rather than reactive. And the general summary here was that you want to begin planning for your taxes by meeting with your tax professional periodically throughout the year versus only meeting with them during tax filing time. If you're meeting with your tax professional only during tax filing time, you are reacting and you're behind the ball. But we want to be planners because planners win, and we want to be proactive because when we be proactive, this gives us the opportunity to live out our mission and our practice, which is to help our clients create, manage, and protect their wealth. And we do that by minimizing their number one expense, which is their tax. I hear a little bit of background on the Zoom. So if you're not muted, that would be great. It's my feedback. So it's maybe somebody in here. No. All right. So can I claim this on my taxes or not? How do we do this? Okay, looks like my clicker is not working as well once we get the Zoom in here, so I will click this way. What are write-offs? Or what is essentially a tax deduction? There's a big misconception. A lot of people think that a tax write-off or a tax deduction is you getting money back. No, that's not what a tax write-off is. What a tax write-off is, Code Section 162A tells us that it's anything ordinary and necessary in the pursuit of income. That is the true definition of what a tax write-off is. So whether if it's ordinary and necessary in the pursuit of income varies depending on the business. But today we're talking to agents. So what are some of the things that you may be thinking about writing off, but you don't know if you can write it off or not? One of the best questions that you can ask yourself is, hey, do I need this to make money? That's it. Do I need to make this investment? Do I need to make this purchase in order for me to make more money? Okay. In order for me to get that listing. In order for me to get that buyer that's overqualified and that's ready to roll. Pre-approval is on point. You know it's on point because you're working with the lender as well, right? And you know they've done their due diligence. But we also start talking about home office, meals, auto, real estate professional tax status, which a lot of folks don't know exists, but there's actually a tax status for real estate professionals. We'll talk about travel. We'll talk about health insurance, and we will also talk about retirement as well, which we see as something business owners, unfortunately, put on the shelf a lot of times when they're actively running and growing their business because they're so far deep with boots on the ground that they forget to actually plan for the day that they ultimately won't be able to do it anymore. So we're going to chat a little bit about that also. Okay, home office. There are 2 common methods for us to be able to take a home office deduction. I love the home office deduction. I cannot tell you how many people we talk to that are actively working with another professional and their previous professional told them that they could not take a home office deduction. Okay. My goal is to not take away things from you. My goal is to find a way to get things to you. And when I say get things to you, I am talking about tax deductions that you ultimately qualify for. Okay. And the best gift a tax professional can give you is to say, hey, Eugene, here's how we can turn some of your personal expenses into legitimate business expenses. And we'll talk about that today as well. So there's two ways that we can take the home office deduction. We can leverage what is known as the simplified method. And the simplified method is exactly how it sounds. It's very simple. They say, hey, if you have a place that you can use regularly and exclusively for business purposes, then that's a home office. And the beautiful thing about a home office is, depending on your setup, it doesn't cost you any money. So if you have a home office that's 300 square feet and the IRS give us $5 per square feet, that's a $1,500 tax deduction with your name on it. And the beautiful thing about that is you did not spend any money. Okay, so you got a $1,500 tax deduction and no money left your pocket at all. All you had was a place in your apartment or a place in your house that you use regularly and exclusively for business, to send out contracts, talk to sellers, to talk to other agents, to talk to your loan officers, your partners, your referral partners. That's it. Okay, and I'm pretty sure everybody in this room, everybody on this Zoom has a place dedicated where they can do that from. I think you had a question in the back.
$5?
$5.
It's always $5.
It's $5. Yes.
So my question is, we just moved to a new house, which is considerably smaller than my last house.
Mhm.
So my office is in my bedroom. It's like
Okay.
a section of the bedroom. Can I still claim that, or is that getting a little?
All right. So the question on the floor for the folks that are on the Zoom is, scenario, we just moved and my office is also I have a place in my bedroom where I also do work. Can I leverage that place as my home office? Technically, no, because it has to be a space that you use regularly and exclusively for business purposes. So if you're sleeping in that room, then it's also, we kind of walk in that line too far left into it's personal as well, right? We're not using that space exclusively for business. So technically it's no. But I start to ask, hey, do you have a basement?
It's sort of, yeah, I have teenagers, so I have very little space.
Okay. So for you, it's a little bit tricky, okay? With the simplified method. Now, this brings us to the actual area method, okay? And one thing about our practice that we do is we study and we read all the time IRS publications, because the publications will tell you what the revenue agent is looking for, okay? And a lot of folks don't. Here's a little IRS education. So you have what is known as revenue agents, and then you have what is known as revenue officers, okay? They're both auditors, examiners. The difference between the two is the revenue agent is the person that's going to come knock on your door and say, hey, can we schedule an hour, 15 minutes to talk? The revenue officer, this person is typically just calling in by phone. Hey, we can do everything by mail and so forth. That revenue agent actually gets a commission. They get a little bit of a bonus based on what they collect. So they are incentivized to collect. And so we are always looking at IRS publications for this matter, because we want to see what they're looking at, how they're examining certain cases. And so this brings us to the actual area method. The actual area method basically states, hey, let's look at the total square feet of your apartment, okay? Or the total square feet of your house. Let's say it's 1,000 square feet. What's your name? Kathleen. So let's say the total square feet of the house is 1,000 square feet. Okay, and you use 300 square feet for business purposes. What percentage is that? 30%. So now I'm eligible to take 30% of the mortgage interest, 30% of the utilities, 30% of the property taxes. Essentially, I can deduct 30% of everything that it costs me to do business outside of my house. All I have to do is be able to justify how much of my house that I use for business purposes. Now, With the actual area method, this one they do look at. So depending on what other strategies we're implementing for a client, we may say, hey, let's just do the simplified method because we're doing X, Y, Z as well. But if we're not as aggressive with some of the things that we're doing, we may say, hey, yeah, let's go ahead and take the actual area method. So there's a balanced approach that we're looking for that we want to make sure that we can ultimately accomplish while ensuring that when we submit a tax return, that our client goes under the radar, right? We just want them to get passed through. Now, here is some more education on how a tax return gets flagged for an audit, okay? So every single tax return in the United States gets scored, okay? As soon as it gets submitted, there is a computer that scores that tax return. And that score is known as a diff score, okay? It is known as a diff score. Nobody knows how they calculate that score. They will not tell anybody. However, there are some things that we can look for to see, okay, will this increase the person's score or not? If the score increases, instead of it just automatically getting submitted, well, it gets submitted, but instead of it automatically getting pushed through and it's done, higher the score, it gets to an actual human person, okay? So our goal is to make sure we keep that diff score in a good position. I saw you had a question. Can I come back to you? Okay, we got a lot of stuff here, but I got you. All right, so meals. And if you guys have questions on the Zoom as well, you can drop your questions in the chat. I will look at the chat periodically as we're going through the party here to ensure that your questions get answered as well, because you're just as valuable as the people that are present. So meals, I cannot tell you the last time I went out to eat and that meal was not tax deductible for me, okay? I just can't tell you the last time that was the case. And the reason being is because I am always talking about business. I will find a way to talk about business. I will find a way. The IRS says, hey, as long as you discuss business before, they give us 3 times, before, during, or after the meal, then that meal is 50% tax deductible. That meal is 50% tax deductible. So maybe you haven't saw your friend, your partner in a while. And so when you guys first get to your favorite place, to Kathleen, what's a good place you like to go out to eat?
Hollander, Cafe Hollander.
Cafe Hollander. Okay. So let's just say you haven't seen your girlfriend in a long time. And so the first 15 minutes, you guys are just catching up. Hey, how's it going? How's the business? How are the kids? How's life treating you? Okay. Well, then they say you can talk about business during the meal. If you're anything like me, when the food is good, I'm not talking, right? I'm eating. I am not talking, okay? Then they say, hey, even once the meal is done, that's your last opportunity to talk about business. And for you guys, it's so easy. All you have to do is show a house on your phone. Hey, I showed this beautiful house to a client of mine earlier today. It had 4 bedrooms, 2 baths, located in Wauwatosa, Whitefish Bay. I mean, it was amazing. It was great. Nice backsplash, right? Fully renovated. The owners, the sellers, they did a very good job with protecting the integrity of the property. Do you know anybody that might be looking right now? It's that simple. And there's a saying in business that goes, always be selling. You guys know about that? I got one person that said, oh yeah, that's it. Always be selling. I am always selling. Because in the business that we're in, your income stream is dependent on what you sell. We eat what we kill. So we have to get out there and earn. And what better way to do that than to also get a tax deduction as well? Okay. So that's meals. As long as we can discuss business before, during, or after the meal, then that meal is 50% tax deductible. Vehicles. Realtors drive a lot. You guys will be in Kenosha at 10 a.m. and then you will be in Madison by 4 p.m. Trust me, realtors drive a lot. We have over 500 realtors as agents in our practice. The mileage deduction for 2025 is 70 cents per mile. 70 cents per mile. Before we do it, it'll be $1 per mile. Okay. All we have to do is just track our miles. How do we track our miles? You can use an app known as Mile IQ. On my way here today, I opened up my Mile IQ app. I clicked start, and it tracked my miles from me leaving my home office. Keyword, home office. Because when you leave from your house to go to that first showing, okay, that's technically commuting miles. Commuting miles are non-deductible miles. But if you have a home office, okay, I am now leaving business to business. Therefore, I am now creating an opportunity for me to be able to capture those miles as well. You see how certain strategies kind of pick up and play on each other? And this is why I'm encouraging for all of you guys to have a home office. It should be non-negotiable. You and I have a chat on how we can figure something out. So there's one route. We can do mileage. The second way is through what is known as direct expenses. Similar to the home office, right? It was simplified, which is in this case, we can call it mileage or actual area method. But in this case, actual direct expenses. So what's the difference between the two, mileage and actual direct expenses? The difference is we can now deduct the exact amount that we paid for our oil changes, our tire rotations, essentially anything that costs us to keep that vehicle in service for us to get from point A to point B. But we cannot do both. Okay, we cannot take mileage and also take direct expenses. We can only do one or the other. Then what they say is, okay, you can start out taking mileage on that car, but if you ever switch and you start taking actual expenses on that same car, you're stuck at actual expenses. So we can switch from mileage to actual, but we can never go back. Okay, those are the rules on that side. You got a question? Oh, they can't see the screen?
No, they can see it. It's just, we just have to stop sharing and then reshare, which is right here. And then we're just going to reshare this one,
That one.
this one, share. Hey, Willis, is that better?
Yes.
Yes, okay. Okay, and then,
Current slide.
wait, this one?
Yes.
Okay. Okay.
That better? We all good? Party back, people.
Yes.
There we go. All right. So, I think I left off on actual expenses. Okay, so we can switch from taking mileage to actual, but once we start taking actual, we can never go back. Okay, so let's spend a little bit of time talking about actual for a second. If you finance the car, then we can only take car note interest. Okay, we can't take the car note payments, but we can take the car note interest. Okay, up to the portion that we use that vehicle for business purposes. Here is where a lot of tax practitioners fail. Okay, we see it all the time because they don't do the audits and they send their audited clients to us, and then we pick up the audits for them. Okay, so they fail because they'll tell their client, they'll say, hey, since you're not doing mileage anymore, you don't need to track your miles. I just need you to track the receipts, okay? Or how much you spent on the car for gas, repairs, that's it. You don't got to track your mileage anymore. Wrong, okay? Wrong. If for whatever reason your name get pulled out of the hat and you get audited, they will get us here, okay? Because what they're gonna say is, well, how do we know the percentage that you use that car for business purposes? So you still have to track your miles regardless. So if I drove 10,000 miles for the year and I drove 5,100 miles for business purposes, then I use that car 51% of the time for business purposes. So I can take 51% of my oil changes, 51% of all of the direct expenses that it costs me to keep that vehicle in service. But if you're not tracking your miles, then that revenue agent is gonna, he or she is gonna beat that up all day. They're gonna win on that. Okay, they're gonna ding us. So now a lot of folks get confused and they wonder, well, when should I do mileage or when should I do actual? Okay, so in the first year, what we always recommend, every year actually, until we switch to actual, we say, hey, track both. Track both. Okay, if it's not too cumbersome, track both. Let's see how much you're driving in miles. Let's see how much you spent on the vehicle. And then whichever one is more, we'll take that one. Okay, that's one approach. All right. Well, we have clients that have multiple cars. Some of you guys may have multiple cars. And some clients, some folks, they like to drive nice things. They like nice stuff. They earned it. So depending on the type of car, we may say, hey, typically a luxury, newer vehicle, you may not drive that vehicle every day. That might not be your work vehicle. So that vehicle you might not put a lot of mileage on. So since you're not putting a lot of mileage on that vehicle, we should go with actual expenses, actual direct expenses, okay, depending on the vehicle. Now, this is what's in talks. We don't know if it's actually going to happen, but if it does, they are actually also thinking, so what we're talking about right now is business expenses, by the way. We haven't got into anything personal. We're just talking about business expenses. However, there is talks of making card note interest fully tax deductible for everybody. We'll see if that actually happens. If it happens, personally, I think it'd be a great gift to American taxpayers. Now, to just push the presentation along, I do want to spend just a quick second talking about bonus depreciation. So in 2022 and 22, it was a lot of folks, they were buying trucks, G-Wagons, cars that basically weigh 6,000 pounds or more because due to the TCJA, Trump Tax Cuts and Jobs Act, folks were able to write off 100% of the vehicle that they placed in service as long as it weighs 6,000 pounds or more. That's phasing out by 20% per year. Last year, it was 60%. This year, it is 40%. Okay. Now, there's also talks about reverting bonus depreciation back to 100%. We'll see if that happens. Any questions from anybody in the room on mileage or actual?
And this last one, you call it bonus depreciation, is also known as accelerated depreciation, is that the same thing?
Yes.
Okay,
Yep.
because I like that in the past.
Oh, I
I
like
used
that
to
one
have
too.
Forerunners, every year I traded out.
I like that one as well. I love that one.
Nope. I don't know what.
You can keep going with the
Yeah,
question.
keep going.
Okay. All right. Next question, please.
I just have a clarifying question. So if we're tracking our mileage, do we need to track personal and business so they can see what percent of your total is business expense? And does that app allow for that?
Great question. If you're using an app, then whatever you log, your app is going to track all of your miles, regardless.
That's
All you have to do is just not this presentation.
Oh,
Excuse
just
me.
kidding. We're making investments.
Yeah, can they not see it?
It's just sharing. As like where we can see every single one at the bottom.
Okay. 1 second.
We want to keep each slide a surprise. Don't want to give too much away. Yeah, we just have to use the slideshow.
Sorry, there's some stuff on that one that,
We are all good. So then when we share that,
okay, what do they see now?
we just have to have it say, so do you want to pull up? So you're sharing your screen right now.
Uh, where is it? No. Here, let me
Oh, he
stop.
said he can see it perfectly. Okay,
Don't move everyone.
wait, but then he did a sad face. Oh, we're good. Okay, there we go.
Okay, what do they see now?
He said there, just,
They're good?
yes?
Okay.
Hybrid just makes things really complicated.
Everything's
we're
all good? Did that answer your question?
You said that the app tracks everything.
Yes.
Okay. I just have to finish things our business.
Yes. Does anybody in the chat have a question?
So,
Okay. Awesome. Sorry, guys. I wish that we wasn't having these difficulties, but we're going to keep this show rolling. So now we're going to talk about real estate professional tax status, and I'm going to bring up the accelerated depreciation again as well. Okay. So what is real estate professional tax status? Why does it matter? Has anybody brought up real estate professional tax status to you guys yet? The first one? Anybody here working with another tax professional and they didn't bring this up to you? Okay. So our goal, this is my personal goal, okay? And quick disclaimer, I am a real estate guy. I love real estate. I breathe, preach, sleep real estate. I know it inside and out. I've been buying real estate since 2017. I have over 57 units. I'm always looking, I'm always buying. So I understand real estate. Now, our goal is to equip our clients with the ability to be able to get real estate professional tax status, because this status, okay, is the holy grail from us being able to say, hey, instead of you paying $100,000 in taxes to you legally paying $5,000 in taxes. Or in some cases, we do have some clients that don't pay anything in taxes. Very rare, but those opportunities, those scenarios do exist. Real estate professional tax status is the vehicle to get you there. So what is it? All right. Before I share what it is, I have to tell you why it matters. And there's everybody, the IRS has a bunch of rules and codes that, like, it's just hard for people to understand. They word stuff in a way where it's like gibberish. Like, what the hell is this? What does this mean? Okay. And what I tell clients all the time is your goal is to find somebody that can articulate all that gibberish into something that's simplified and easy for you to understand. That's it. So they came up with this rule and they said, once your income goes above $150,000, you are not able to take any losses from your rental real estate if you own rental properties against your W-2 or income from your business. Okay, what did you just say? Okay, here's what I just said. So basically what happens is everybody on this Zoom, everybody in this room, you get a $25,000 special allowance. So if you own real estate, you get a $25,000 special allowance. Okay, real estate typically on paper goes negative. And it goes negative because of my favorite word in the entire tax code, which is depreciation. Okay, it goes negative typically because of depreciation. Okay, but it's cash flow positive in your bank account. If it's cash flow negative, then we should probably think about selling, right? Fix what we can, list it, get rid of it. Now, if I'm earning $100,000 a year in my business and I have a $25,000 loss against my rental property, instead of you being taxed on 100,000, you're now only being taxed on 75,000. Okay? But they say once your income goes above, 150,000, that $25,000 special allowance goes away. You cannot use any losses from your real estate to offset the income that you're generating in your business. That loss can only offset other passive income, so other income from other rental properties. So they put up this wall once your income goes above 150. My goal is I want to get rid of that wall, okay? I want to get rid of that wall because I want us to be able to leverage, if we do have real estate, leverage the real estate to offset the income coming in from my business. And that's why real estate professional tax status is important. I'm going to actually show you a client who was also an agent that implemented some of the things that actually this client did every single thing we told them to do. Love those clients, right? We have some clients, we talk to them, we say, hey, do this, do that, do this, do that. We talk to them again in a month. Hey, what'd you implement? Oh, nothing. Another client, hey, what'd you implement? 30% of what we told them. Another client, what'd you implement? Every single thing you told me to do, I did it. Perfect. We love those clients. So how do I qualify for real estate professional tax status? Okay. So if you have any interest in rental real estate, essentially what has to happen is you have to spend more than 50% of your time, okay, and more than anyone else on that particular property and 750 hours. So we have a lot of investors that have property management companies. Well, this is where they run into a little bit of trouble, because if they have a property management company, then we need to track the amount of hours that that property management company is spending on those properties along with your hours as well, because you have to participate more than anyone else. Okay. But then, of course, somebody at the IRS level, it's always somebody, they said, hey, 750 hours, more than 50% of my time, and more than anyone else is too much. I had other stuff I'm doing. What can I do? Well, this thing known as short-term rentals came out, Airbnb, VRBO, and what happened was they said, hey, if you have a short-term rental where the average stay of your guests is 7 days or less, then all you have to do is materially participate for 100 hours. 100 hours is a lot easier to do than 750 hours. Okay, and then if we do that, this gives us the opportunity to be able to take all of our passive losses against our active income, and it gives us the opportunity to do some more sophisticated stuff, which I'm going to show you in a second. Travel. Anybody here like to travel? I love to travel. I encourage clients all the time. If they got a business that's doing well, hey, you should have a board meeting at least once a quarter. You should have a board meeting at least once a quarter. If you're a single member LLC, then you should establish a board of advisors. If you're an S Corp, technically you should have a board of directors, okay? And you can travel with your board. So if you have a spouse, you have a significant other, you can appoint your spouse as a board member. So when I go to travel to Utah to go hike, or when I go to Miami and have my board meeting and I bring my significant other, I'm bringing a board of director with me. So now this is giving me the opportunity to be able to write off all of their expenses as well. Because I'm no longer traveling with my spouse, I'm traveling with a board of director, or I'm traveling with a board of advisors. And while we're there, we are going to have a board meeting. Okay, so how do we write off travel? One, we can have a board meeting. Two, IRS says that, hey, you have to work a minimum of 4 hours a day on a working day. A working day is Monday through Friday. So typically what we'll encourage for a client to do is to, hey, make Thursday your travel day. So Thursday is your travel day. You're in the air, right? You're traveling, whatever. So we get to the airport, tax deductible, right? We're in the airport, might be hungry, doing a little bit of work, doing some business. You might be having a Zoom meeting, whatever. Okay, talking to a buyer, get a little bit of food. Okay, now I'm talking over business, over food. Get in the air, land, check in my hotel, tax deductible. Okay. Friday, all I have to do is discuss business or do work for 4 hours. Excuse me, I got to do work for 4 hours on Friday. That's it. So from 8 a.m. to 12, I work, and the rest of the day I do whatever I want. Saturday, Sunday, I also do whatever I want. Okay. Monday, I work another 4 hours. Tuesday, travel day, I come back home. Do you think Saturday and Sunday is tax deductible? Anybody? Absolutely. Okay. This is how we can write off the weekend as well. Now, there's a few other things that we do in this case to ensure that everything is zip tight, which we can chat more about in a more intimate conversation. But health insurance, okay, health insurance is 100% tax deductible. 100% tax deductible. If you're self-employed, you have health insurance, 100% tax deductible. Okay, retirement savings. So yes, great question. So essentially, in order for us to be able to write off health insurance when you're an S Corp, it has to be included in your W-2 wages. Okay, box 14 of your W-2 wages, and it should say health on your W-2, and your tax practitioner should know to make the adjustment on your personal return to deduct it against the W-2. But technically, those are the rules with deducting it. Now, moving to retirement. I love the solo 401k, personally. Okay, with the solo 401k, we can defer up to $23,500 in wages. So let's just say we're an S Corp, okay, in this example, and we want to push everybody to the S Corp as quickly as we can, okay, if and when it makes sense. But when we become an S Corp, we have to pay ourselves a salary, okay, also known as reasonable compensation. One of the rules of being an S Corp, okay, an actual W-2. So you're paying state income tax, federal income tax, right, FUTA, SUTA on that. Well, the first $23,500 that you pay yourself, and you and I will have a conversation on how much should you pay yourself, because there are some strategies on that as well. Because every time you run payroll, you pay self-employment tax, and we want to keep your self-employment tax as low as possible. Okay, but the first $23,500 that we pay ourselves, we can just kick it down the road and put it into our solo 401k. And the beautiful thing about the solo 401k is you can contribute a maximum of $70,000. Okay, if you're under 50. And the business can match 25% of whatever you paid yourself through the business. If you're under, it doesn't matter how old you are. Okay, the business can match 25% of whatever your W-2 wages are. Now, I'm a big fan of the Roth IRA as well. But once your income goes above 161,000, if you're single, then they say, hey, you're phased out. You can't contribute to a Roth IRA anymore. You have to do something else. Okay, can't tell you how many people was like, oh yeah, I wanted to contribute to my Roth, but my tax person told me I couldn't. Well, did he or she bring up that you can do the backdoor method? And the backdoor method is relatively simple and easy. All we do is we just contribute after tax dollars to a traditional IRA, and then we just roll it over right away. Done. Okay, and when I say roll it over right away, we're rolling it over into a Roth IRA. So all of that money in the Roth IRA is growing tax-free. And when we turn 59 and a half, we can pull that money out, pay no tax, and do whatever we want with that money because we earned it. All right, now I'm going to speed this up just a little bit here. So we talked about real estate professional tax status. Now, for my agents on the call, and for my agents in the room, and you're actively working with investors, okay, you should get a little bit familiar with this. We have a lot of high income clients that they're trying to find a write-off. Okay, and they love and they like real estate. It's something they can touch, they can see it, they can control it, right? It's cash flow, it's supplemental retirement. But if we can get that person to qualify as a real estate professional based on the two tests, the two options I showed you guys earlier, either 750 hours or short-term and 100 hours, they can do a cost segregation. What is a cost segregation? A cost segregation is basically where a engineering company come out and they're looking for everything on that house that has a useful life of 15 years or less. Okay, so I'm in a room full of a bunch of agents. Okay, name something that has a useful life of 15 years or less. Who we got?
All appliances.
Appliances. Water heater.
My phones.
Furnace.
On roofs.
Roof. Right? And so what they're doing is, instead of us depreciating that property over 27 and a half years, they're allowing us to get a bigger deduction in year one. So instead of us getting, let's say, $9,000 a year, they say, hey, you can get $60,000 in year one as a depreciation deduction that you can leverage against your active earned income. Okay? So the downside to a cost segregation study or depreciation in general is if you sell the property, there's something known as depreciation recapture, which is just a complicated word to say whatever depreciation you took, you got to pay it back. Okay, and that's on all rental properties, by the way. Okay, now here's a client that listened to every single thing that we told them to do. And this client is a realtor, okay, doing very well, killing it. Okay, communication is on point, building a large team. And he's like, hey, I like real estate. What can we do? We did a cost segregation study on one of their properties. Okay, he was making his estimated tax payments periodically throughout the year. And we were able to get back for him over $100,000. Okay, he got $90,000 back from the state, from the IRS, and then he got over $16,000 back from the state. What do you think he did with that $100,000 refund? He reinvested it. He reinvested it and he bought some more real estate. Not only did he buy some more real estate, but he took his wife, he took his family, and they all went and had a board meeting in Utah. Right? And so now we're creating an opportunity for our clients to be able to enjoy more of their money. That's what this is all about. Right? That's what this is all about. You work hard for your money. How many showings did you have to go to? How many times did you have to talk to that client, to the buyer, to the seller? All right, well, what about that agent that was just like hell and hot water to work with and they just don't get it, but you got the deal done? Okay, so you work very hard to earn your money. You should be protecting your money. And unfortunately, we spend a lot of time trying to figure out how to make money, but we don't spend money on figuring out how to protect the money that we made. Isn't that weird? We spend money trying to figure out how to make money, but we don't spend money trying to figure out how to protect it. And this is why it's very important that you guys have a qualified, a licensed tax professional that you're working with that understands, one, your lifestyle, okay, two, your goals, and three, how to wrap the tax code around that. That's what's most important. And I'm going to quickly go through this slide here. A lot of people don't know that you can actually invest in real estate through your retirement account as well. Okay. And all you have to do is self-direct your retirement account. We got a bunch of clients that do fix and flips in their retirement account. Like this is what they've been doing for the last 15 years. They know real estate like in and out. Okay. They're doing 5 to 6 projects a month. And some of the projects they're doing it in their retirement account. Okay. And your retirement account can actually invest in other businesses. Facebook, got seed capital from a retirement account. PayPal got seed capital from a retirement account. Okay. All right. Now, if your business is netting over $40,000 a year, you should consider being taxed as a S corp. This is one of the first things that we do with all of our clients that are agents, right out the gate. Okay. Okay. How much did you earn last year? What are you on track to earn this year? Cool. How are you getting paid by your brokerage? Are they paying you directly or are they paying an entity? Okay. What do they have on you as it pertains to a W-9 on file? Because the first thing that we say is, hey, let's go ahead and create the entity right away, regardless. Let's just create the LLC right away, because what we're doing is we're setting up the opportunity for you to have the ability to be taxed as an S corp. You lose that right if you have all of your income going to you directly in your personal name. So we at least want to have the option to do it at some point if we're on the track to do it. So one of the first things we do, we say, hey, let's create the LLC right away, and then update your W-9 with your brokerage on file. Have all of your commissions go into that business account. Okay, I can't tell you how many agents, we got hundreds of agents in our practice that we talk to, and they say, oh yeah, I got a business account. Do you? We continue the conversation. And then I find out that it's not a business account. It's a personal account that they have declared that this is a business account where all my commissions and my checks go into. That is not a business account. That is a personal account. So our goal is to, if you're netting $40,000 or more, hey, let's put you on the S corp, because you're paying 15.3% in self-employment tax on net profit if you're filing a Schedule C. If you have a copy of your tax return and you file on a Schedule C, I want you to find this page, okay? The page is Schedule SE, okay? If you have your income going to your personal name, you have this page, Schedule SE. You will see how much you pay in self-employment tax every year. It should make you mad. It should make you very mad, okay? And then not only that, but you should also see that whoever you're going to file your taxes is allowing you to pay this as well. They're not even bringing this up to you. So what the S corp does is it says, hey, instead of us being required to pay self-employment tax on our entire net profit, which is 15.3%. So if I net $100,000 in my business, I'm paying $15,300 in self-employment tax alone. Plus, I'm paying federal income tax based on my rate on the progressive model. And if you live in a state like Wisconsin, you're also paying state income tax, also based on a progressive model, right? So they hitting us 3 times, right? But when we switch to the S corp, we are now in control of how much we pay in self-employment taxes, because we only pay self-employment tax on what we run a W-2 payroll for on ourselves. This is why a lot of people who switch to the S corp get in trouble, because they're not running any payroll, and the IRS say, hey, you got greedy. We gave you the S corp so you can save on self-employment tax, but you got too greedy. You didn't run no payroll. You still got to give us something. And so our goal as tax practitioners, or in Magnolia, I shouldn't say our goal as tax practitioners, because there's some tax practitioners out there, they're working for the IRS, not for you. But you think they're working for you, right? So, do you have proper bookkeeping? There's a saying that goes, whatever you don't track and trace will go away. Whatever you don't track and trace will go away. That's in everything. You should be measuring and tracking everything that you're doing, okay, to some degree. And one thing that we should be tracking and tracing is, where is the money going? Where's the money going? How do you know if you're profitable? How do you know if you're not profitable? How do you know if this marketing is not working? Are you tracking how much you spent on Zillow ads? Are you tracking how much you spent on sponsorships? Are you tracking how much business you got back from that sponsorship? Okay, well, how much does it cost? How much does it cost for you to get one lead? All right, well, how much does it cost for you to get one deal closed? Two different questions. Because you can get a lead, but that lead might not be a qualified buyer or a qualified seller. It could be a time waste. But we should start tracking all these metrics because that's how we grow, that's how we scale the business. I recommend you guys to use QuickBooks. Okay, QuickBooks is a software that you can use where you can track and trace where the money is going, and you can also put automation in place. So every time you go to Cafe Hollander, it knows that this is meals. And or you should consider hiring an accountant that can help you with this. All right, second to last slide. So alternatively, our goal is to do this, to create this for you, what you see on the screen. Okay, this is where we really get the ability to fulfill our mission as a practice. Our mission is to help our clients create, manage, and protect their wealth. And what we do is we want to build out the left side of the right side of your life as much as possible. Okay, this asset passive income side. And that's with your retirement, that's with rental properties, we got the HSA, and then we have everything flowing into a revocable living trust, okay, which ultimately flows into your 1040 tax return. So we're here, right? We're grinding, hustling hard, and we're getting the listings, we're getting the closings, we're making the money. Cool. We make the money and then we park it over here. Okay. And we're buying things that are ultimately giving us a deduction that our future self will thank us for. Okay, that's the whole goal. How can I buy something that I can get a deduction now that my future self will thank me for? That's what we're doing. And we're living, in 10 years, we're going to be living in the decisions that we made now, because right now we're living in the decisions that we made 5 years ago. So if we know this, then let's just implement it. Let's just start now and let's get smart, let's get creative, let's get the right team around us so that we can be successful. Okay, so this is our goal here. Now, a lot of people may ask, well, why should I have the life insurance payout going to my trust and not to my beneficiary that is tax-free money? Why should I have it going to the trust? Well, part of the reason why we have it going to the trust, depending on if you have kids and so forth, statistically, kids, folks really don't start to develop the proper financial habits until 25 and 27. And if you have a nice size insurance policy, man, can you imagine a 21-year-old, an 18-year-old getting, $100,000 at once, $500,000 at once? If you've never seen them go on spring break, they will be on spring break before you know it. I'm telling you right now. But the trust gives you the opportunity to be able to say, hey, Eugene, look, the first $100,000 must be spent on a down payment for a house. Okay. Maybe it goes to grandkids. It can go to whatever. Maybe it goes to a business. So this is your opportunity to be able to still set some controls in place that ultimately give you the opportunity to ensure that their future is well off. So that's my time. I appreciate you guys for hanging with us today. I hope this was a party that was good for you. And I hope you wake up with a nice hangover, right? And you had a lot of fun and you learned something. And I gave you at least 3 or 4 things that you can go out and implement in your business right away. I get fired up when I give these presentations. If there's any questions, I will take them right now. And I only got 5 minutes. Thank you.
Thank you very much.
All right. Any questions on the Zoom? No. All right. Thank you, guys.